Let me start with a dangerous question. What if the most powerful technology ever created becomes the catalyst for the next global financial crisis? On the left side of this slide, you see AI capability going vertical, exponential acceleration, order of magnitude growth, the curve that changes civilizations. On the right side, you see something else. Economic stability trending downward, first volatility, then displacement shocks, then credit contraction, then systemic risk. Now here's the paradox. We are trained to believe technological progress equals economic growth, more productivity, more wealth, more stability. But that relationship assumes one critical condition, that productivity gains flow through households. What if AI breaks that transmission mechanism? What if intelligence becomes so abundant that the very thing modern economies depend on, high-income cognitive labor, collapses in value? That's the paradox. The better AI gets, the more fragile the financial system may become. Let's stress test the consensus. Right now, markets are optimistic. AI is boosting productivity. Corporate earnings are resilient. Liquidity is abundant. 2025 looks like a liquidity-fueled bull market. But by 2026, we may start seeing sector-specific stress. Why? Because the global economy operates on a loop. Innovation, higher productivity, higher wages, increased consumption, growth. This is the post-World War II formula. Technology made workers more productive, workers earned more, they spent more, corporations earned more, markets rose. But AI is different. AI doesn't assist labor. It may replace it. If productivity rises while wages fall, the loop breaks. And when the loop breaks, the engine short circuits. This isn't a supply shock. It's a demand shock. And demand shocks in leveraged economies are dangerous. Let's talk about scarcity. For decades, cognitive labor was scarce. Thinking, analyzing, coding, designing, these were premium skills. White-collar work commanded high wages because intelligence was limited by biology. AI changes that. When intelligence shifts from scarcity to abundance, its price collapses. Imagine diamonds becoming as common as sand. That's what happens when cognitive processing becomes effectively free. The premium evaporates, wage compression follows. And here's where this becomes macro-relevant. The middle and upper middle class, the cognitive class, are the consumption engine of developed economies. If AI compresses their incomes, the downstream effects are enormous. This is not about unemployment headlines. This is about structural repricing of human capital. And financial markets are not priced for that. Let's zoom out. 70% of US GDP is consumption, and the top 20% of earners drive roughly 60% of that consumption. That means the economic engine is concentrated, highly concentrated. If AI disproportionately impacts high-income cognitive workers, lawyers, analysts, marketers, coders, consultants, the impact isn't marginal. It strikes the core. This is the demand shock nobody is modeling. When housing collapsed in 2008, consumption collapsed because household wealth collapsed. If AI displaces income among the top earners, consumption collapses because income collapses. And income loss is more destabilizing than asset loss. Asset prices can rebound. Structural wage compression is harder to reverse. Historically, technology assisted workers. It increased output per worker. It raised wages. But AI may create something new, a displacement spiral. Technology, worker replacement, wage deflation, consumption collapse, corporate earnings compression, investment decline. This is not theoretical. If companies discover that AI can replace 30% of high-salary employees, they will, not maliciously, rationally. And when multiple firms act rationally at once, macro instability emerges. The paradox is brutal. The more efficient AI makes companies, the weaker aggregate demand may become. Efficiency without distribution creates imbalance. Now let's talk markets. Tech valuations are built on recurring revenue models. SaaS companies trade at premium multiples because subscription income is assumed stable and perpetual. 100 employees want 100 licenses. Predictable cash flow, stable growth, high multiples. But if AI agents replace 60 employees, those 60 licenses disappear, revenue compresses, and when revenue compresses in high multiple companies, valuations don't adjust gradually, they reset. The El Dorado of software, perpetual recurring revenue, relies on human seat count growth. AI threatens the seat count. That's the first domino. Now we introduce leverage. Private equity funds aggressively bought SaaS companies over the past decade. Why? Stable cash flow, low interest rates, cheap leverage. Private credit expanded massively to finance these deals. Revenue assumptions supported debt levels, but if revenue shrinks, debt does not shrink. Leverage magnifies small disruptions into systemic stress. And here's the key. Private credit is not as transparent as public markets. Stress may build silently. Waterfalls of failure may appear first in niche funds, then spread. This is where AI disruption intersects with financial engineering. And that intersection is combustible. Who ultimately absorbs the risk? Pension funds, insurance companies, endowments. They allocated heavily to private equity and private credit in search of yield during the zero-rate era. If SaaS valuations compress and private equity struggles, losses cascade upward. This is not a bank-led crisis, it's a shadow credit crisis. The stability premium assumed in private markets becomes the vulnerability. 2008 was visible leverage. 2028 could be hidden leverage. Let's compare structures. 2008 bubble, housing. 2028 risk, SaaS tech valuations. 2008 leverage, subprime mortgages. 2028 leverage, private credit and PE debt. 2008 belief, housing prices never fall. 2028 belief, software revenue is perpetual. 2008 spark, rate hikes. 2028 spark, AI labor displacement. Crises begin when assumptions break. The question is not whether AI boosts productivity. It will. The question is whether markets have overcapitalized an assumption about perpetual revenue growth. If that assumption fails, the unwind could be violent. Let's map the cycle. AI replaces white-collar workers. Income falls, mortgage defaults rise, consumption drops, corporate earnings miss, equities sell off, asset prices decline, forced selling accelerates, credit tightens, and the loop feeds itself. Efficiency gains are overwhelmed by demand destruction. This is how deflationary spirals begin, not with inflation, but with income compression. And in highly leveraged economies, income compression is destabilizing. What should we monitor? First, long-term bond yields. If the 10-year yield drops rapidly, markets are pricing recession risk. Second, SaaS churn rates. Are subscription models stable or quietly deteriorating? Third, private equity write-downs. Are valuations being marked to reality? Crises don't explode overnight. They leak first. Bond markets move before equity markets. Private credit cracks before headlines. The signals will be subtle at first. This is not a prediction. It's a gray swan. Low probability, high impact. But here's the uncomfortable truth. AI's disruptive potential is not speculative. It's visible. If intelligence becomes free, how does the economy price labor? If labor income compresses, how does debt get serviced? If debt cannot be serviced, how do asset prices hold? The AI revolution may create extraordinary wealth, but transitions between economic regimes are rarely smooth. The link between AI, labor displacement, leverage, and asset prices is real, and it may define the next decade. We stand at a crossroads. AI could usher in a golden age of productivity, or it could expose structural fragilities in a system built on debt, consumption, and income concentration. The key variable is distribution. If productivity gains concentrate at the top while wages compress below, instability grows. If productivity is redistributed, the transition stabilizes. Markets today price acceleration. They do not price structural displacement. And that gap between capability and stability is where gray swans are born.